Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 243. Will FIIs ever buy? This is a very frequent question now being asked of me, and we will try to go over some analysis on this. And definitely, yes, FIIs will buy again, but for the time period going past last 9 months, they definitely have been sellers. So market was soft from the very start, very volatile. Initially, in the first hour and a half, waiting for the RBI to come out with the uh, monetary policy rate hike. It was expected 0.4%. They delivered 0.5%. There was a sort of a relief rally that immediately pursued after this announcement. Nifty went up almost 100 points from there, but then it all gave it back up and ultimately closed minus 0.3% down. Real estate stocks seem to be quite buoyant with this RBI hike out of the way, at least for now. The roadmap and expectations of home loan buyers are clear. So from that perspective, real estate companies did well today. PSU banks also did quite well, 0.7% up. IT stocks were slightly up. Pharma stocks mildly. Major hits that happened was on FMCG, infrastructure, consumption, energy stocks, and private banking. There has been a narrative that is going around that FMCG stocks are getting very badly hit due to the inflation uh, and them not being able to pass on the inflation, and that is causing immense sort of margin pressure for FMCG stocks. Overall, not such a good day. In the last 1 week, also reasonable cuts of single digits on several sectors, and a week actually to kind of forget. Overall, in broader indices, the silver lining was that small caps didn't fall today, virtually 0.17% down, and mid caps were also down 0.3% only. So there was no sort of waterfall impact on small and mid caps due to large cap fall. Uh, in terms of the weekend investing strategies, also ATH and Evergreen were hit more than a percent. ATH2 was down 0.83%. Several of the others were down between 0 and half a percent, and there were hardly any, there were no gainers actually. So the strategies were hit more than the market in many cases, but the current softness in the market is causing this kind of a lethargy in the strategy returns also. So heat map for the day, it's a Nifty 50 heat map. The larger the box size, the larger is the market cap. So we can see immediately that the big loser today was Reliance Industries. Although TCS was there to give a counterbalance to it, HDFC, Infosys, HDFC Bank, Bajaj Finance, these were pretty much flat. ITC was down 2%, Bharti Airtel down 3%, and the private banking sector was down. Asian Paints down 1.5%. So several key stocks in the Nifty taking some beating, but some notable gainers were Maruti at plus 1%, Titan at plus 1%, and there was Tata Steel at 1.7%, and State Bank stood out in terms of the larger ones as the sort of the hedge against the rest of the market post the RBI announcement. Top gainers in the CNX 500 universe: TV18 and MRPL up nearly 10 to 11%, Network 18 up 5%, LG Equipment and Macro Developer up 5% each. As I said, real estate stocks are doing well. Gujarat Gas continues to fall, down 7%, Aptus Value down 6%, GNFC, Suprajit and Haikal all down more than 5%. So very mixed market, some stocks going up, some stocks coming down. Pretty much directionless from the perspective of the larger trends. So coming back to the topic, will FIIs ever buy? So we've had several episodes in the last decades where FIIs have sold for several months together. So this slide is from a presentation by Motilal Oswal, and we can see that the number of months of net FII selling in the previous 12 months has been several times more than 7 months. So here in 2008-9 we had about 9 months of selling, or maybe 8.5, and then again in 11-12 we had about 6-7 months of selling, and then another 3 months of selling here, and then post the Modi wave another 6-7 months of selling here, another 8 months of selling here. So there have been bouts of 6-7-8 months of selling, and right now in the current period we've seen 9 months of net FII selling in the last trailing 12-month period. So this is becoming now an extreme position even with respect to the great financial crisis in terms of the trailing 12-month period. Another insight, very nice insight, was posted by Ravi Dharamsi on Twitter. And as you can see here, he has listed several of the periods where FIIs were selling. So GFC, January to March 2009, January 8 to March 2009, $15 billion of outflow. Then in 13, there was $4 billion, $1 billion, $8 billion, 5, 9, so on, so on, so on. And if you come down to October 21 to June 22, the current period, we've seen a $28 billion of outflow. So this may prompt us to sort of conclude that, this is the largest FII outflow, and, India is in a bad state and FIIs are just going away. But we need to see it with the perspectives, and the perspective was there in this insight itself, that the India's market cap at the time of GFC was just 1.8 trillion. It has almost doubled now at 3.5 trillion. The FII holdings at the start of that period was 296 billion. Now it is more than double at $665 billion. So as a percentage of the market cap, 0.9% moved out at that point of time. In comparison to that, currently 0.8% has moved out. In terms of FII holding, 5.2% of FII holdings moved out at that point of time, and we are now at 4.2% of FII holdings. So can't say that the current fall is anything to just forget. It is quite material, but it is not more severe than the GFC at least. Also to note is that during that fall, during that outflow, Nifty went down 57% and mid caps went down 67%. Whereas in the current outflow, the Nifty is down only 0.7% and mid caps are down minus 7% and minus 9%. So from the perspective of the market fall, the market has absorbed almost a GFC kind of sale without impacting the price. And that's a huge insight out of this. So if the fall has to be similar to GFC, then we don't have much to go. And once the money starts to return, there can be a huge upswing. So, in 2008, market went down 57%, 67%, and there was a gush of FII money that came in to, fresh money that came in to, take advantage of that fall. But this time there is no fall. We are down 7% and 9%. So there may not be an immediate gush of money coming in also. So that can be another thing. But I think thankfully, because of the strong domestic flows, the FII outflow has been blunted to a large extent. And the current situation is nowhere near as bad as what we had seen in earlier outflows. So from that perspective, the FII outflow have been quite muted in terms of their impact on domestic market. So going forward, if we have stoppage of these outflows, that's very good. If we have some inflows that start to trickle in, that's also very good. But whenever there is a stronger inflow that comes in, I can tell you that our markets will go up like a rocket. So, it's good that we've absorbed all the selling so far and not had a too bad a price impact on the prices. So this tweet was about a product NNF10, which has won another monthly, I wouldn't say contest, but Money Control comes out with a monthly report on which small cases are doing the best in terms of which are the small cases which people are buying the most. So in this report, which you can access through this our Twitter handle, NNF10 has been chosen as one of them, and NNF10 has been consistently being a top front runner in terms of the best small cases, I think over the last 6 to 8 months now, consistently. And the reason is that the gain to pain ratio, I mean, we are calculating the actual gain divided by the value of the monthly portfolio loss. So average, so sum of monthly portfolio gains and divided by sum of monthly portfolio losses. So for NNF10, that has been hovering in the region of 2 plus. Nifty Next 50 has been 1.7 and Nifty 50 is 1.67. So more this ratio is, more is the gain to pain sort of advantage. So more gain, less pain, or if there is more pain, then even greater gain. ROMAD ratio also is the maximum drawdown, is the average return in a given period for a portfolio expressed as a proportion of the maximum drawdown level. So average returns, CAGR, NNF10 has been over a period of last 10-11 years, including the backtest, if I take, has been 18% versus Nifty Next 50 at 12%, Nifty 50 at 10%. And the drawdowns, maximum drawdowns have been 22% here, Nifty Next 50 at 32%, Nifty 50 at 29%. So ROMAD ratio has been much higher in terms of NNF10. So in all aspects, the strategy has really done well, and as they say, the public sab janti hai. So people have been knowledgeable about the fact which strategy to choose, and they have been lining up for the strategy for this reason. So this is all I had for today's Daily Byte. Thank you so much for watching. Please do like, subscribe, and share this video and other videos that you may have liked. Please do share it with your friends and family, and try to increase our reach to more and more of your dear ones. Thank you so much. Bye.